The benefits of whole life insurance. Yes, there are benefits. Sorry about the shadows. I forgot to turn my light on over there. So, what the? Pablo heard me talk about whole life insurance. He says, I got something to say about that. I love this little. So let's dive into this. Had a lady had emailed me. I just had some peanut butter. Like, this is peanut butter breath. Does a peanut butter breath make you like, it's disgusting. All right, so I had a man, do I love this guy. Oh, you made me so happy, buddy. All right, Papa just wants to eat. He's 13.2 pounds of fur, and he's just like, he acts like he hasn't eaten. He acts like he's went to 4 straight consecutive ranger schools. He's got a belly. Look at that belly. All right, so we had a client, husband, wife. She had bought a whole life policy for many moons ago, and she just had some questions about it. And she actually keeps a very elaborate spreadsheet, which is good. And I'm going to share that with you. She said I could. It doesn't have any personal information on there, but I'm going to show you that whole life in of itself is not evil. Whole life, when it's taken out correctly, is flipping awesome. I'm going to show you exactly why. So let's dive into this. This is her whole life insurance year-over-year comparison, and this is her annual premium. She pays, it's roughly $250 a month, $250 a quarter. Excuse me. So her annual premium. Now, what jumps out me first is when she took it out. So when I saw that she had taken it out in 1993, I said, whatever her name was, Jane, I said, this might be something you want to keep unless the policy is unless you took a loan against the policy, unless you haven't paid premiums. But if you've been making regular contributions, this might be something you want to keep because when the interest rates were so much higher back then, in the late 80s, early 90s, that the guaranteed minimum, I guarantee, is something much higher than you can get now. That's for sure. So remember, with insurance, the interesting thing about life insurance is they're literally taking your premiums and turning around and investing in long-term, highly rated corporate and government bonds. So it's an arbitrage. They're saying, okay, Jane here has a $60,000 death benefit. So if Jane dies, we're gonna have to come up with $60,000 to pay out her husband or her kids. Not likely to happen. All right, so we can do a table. We know the actuaries will do their spreadsheets and whatnot and their bell curves. And they'll say, for every 100,000 insured that we have, 100 will die. And because that, we know what our net at risk is, NAR. And then we can invest the other. And that's the thing about insurance companies. They have this down to a literal science. And so they can literally take your short-term money that you're giving to them and invest it long-term, knowing full well that they're not going to have to pay off for many, many, many moons. So basically, they were buying 15, 20, 30-year bonds. And back then, the bonds were paying in the double digits for that long-term bonds. So they're saying, we will guarantee you a crediting rate, 4.5% or 5% or 3%, whatever it was. We'll just say 4.5%, no less than that. So we know for a fact, Jane, you will get no less than 4.5%. Now, if the insurance costs are way high, that's going to pose a problem, but they're not. Because when you take out whole life insurance, when you take it out when you're young, the costs are low. And the costs are low. The costs are higher as you age. The costs are low when you're young because you're not likely to die. So what a whole life insurance does, it kind of levels them off to cover you for your whole life with a level cost of insurance. All right. So what happens is she makes $1,000. We're just going to say $1,000. She puts it in first year of the policy. She of that $1,000, she only has 120 in a cash value account. That's it. All right. So she put $1,000 in. She has 120 in cash value. Thus, basically 900 went to service the insurance, if that makes sense, with the commission, the cost of insurance, all that. Her death benefit started at $60,470. So essentially, the insurance company ran the illustration and said, look, if you contribute $995 for a certain amount of time, most likely until she's 65, I can't remember, but that's usually the way it is. You'll have $60,000 will be your $60,470 will be your initial death benefit amount. But it'll grow as your cash value grows, and I'll share with that here in just a second. So in this case, her increase in death benefit went up by $264. So at the end of the year, she started the year with no insurance and no cash value and $1,000 in a checking account. She ended the year with $1,000 less in her checking account, with a life insurance component of $60,734 and $120 in cash value. All right, hope that makes sense. Again, she's not likely to die. So this right here is not is actually pretty expensive in the overall scheme of things. But just wait. The next year she did the same thing. She put $995 in, which added from her $120 that she had in cash value. She ended the year with $693. So that's $573 of cash value increase, but she paid $1,000 in premium. So essentially $430 of that went to the insurance company. Increased her death benefit by $279, and on top of that, cost of insurance and all the pay the commission, all that. So she's still underwater. I mean, she's put in $2,000 at this point, and she only has $693 to show for it, plus $61,000 of death benefit. But if she does not die, there is no death benefit, and she will never receive that value of the death benefit because she has to die to get it. Let's just keep going. We're going to go down to about year 6. So she's put $6,000 in. Roughly, she has about $4,400 in cash value to show for it. So far, the cost to her, because she's still alive, and so essentially the death benefit itself is irrelevant at this stage. But the cost to her is the difference between the amount she put in, roughly $6,000, and the amount that's worth, $4,400. So it's cost her $1,600 in which to have $62,000 of a death benefit. Again, pretty expensive for the insurance component, but just bear with me. So now she's still underwater by about $1,600 or so. Put in $6,000. If she were to cancel this policy, it'd only get $4,400 back out. But her death benefit has grown by $2,000. So what happens with whole life insurance is that you start with after the Tax Reform Act of 1986, when a lot of wealthy people were funding life insurance like crazy because it was a wonderful tax-free investment more so than an insurance policy, they got rid of that. So they said they have to make it a corridor so it doesn't what's called MEC, Modified Endowment Contract. And I don't want to get all that, but for a life insurance to look like a life insurance and to keep the tax advantages, it has to have, here is your cash value, here is your death benefit. These two things have to go kind of in tandem. You can't have the cash value growing more than the death benefit. Then it's an investment, not a death benefit, not a life insurance contract. And if it's investment, it will be taxed accordingly under the Modified Endowment Contract rules. So to make it stay as a life insurance, if the cash value grows, the death benefit has to grow. If the cash value grows, the death benefit has to grow. And that's what's happening here is the cash value is growing, so the death benefit must grow. So in this case, she started with $60,000 roughly of death benefit. She has $62,000 6 years later, 5 years later, something like that. And that'll continue to happen. All right, so let's fast forward till right here, 2004, and that she's had this contract policy for 12 years now. She's put $12,000 in, and she has $12,728 to show for it. So basically, she has $728 of gains. She's made $728. Now she's in the black. So what that tells me is essentially she has her life insurance has been paid for. She did not cost her 1 red cent in life insurance. She put $12,000 in. She could take the $12,000 out. She'd get $728 more than what she put in, and she would have had the life insurance coverage that whole time. Now, that's again, it's only $70,000 life insurance, not a huge life insurance component. And the opportunity cost was that she could have invested it potentially and got better. I don't know that to be true because at the end of 2003, the markets were killed. But either way, we stay. She put $12,000 in. She has $12,728 to show for it. She's made a little bit of money, and she had a death benefit at the same time. So the death benefit essentially was free. But watch this. She started the year with $11,191. All right, she puts in roughly $1,000. Right, that $995. We're just gonna round up to $1,000. So she made. She ended the year with $728. So she started the year with $11,191. She added $11,191. She added $1,000 of premium. So that means her basis, if you will, is $12,191. But she has $12,728 to show for it. So she has $537 is what her gain was on that $12,191. So we take $537 divided by $12,191, and she made 4.4% in interest that year, tax-free. Again, She started the year with $11,191. She added $1,000 to the contract. At the end of the year, she had $12,728 in cash value, which means she made a little bit more than $500 of interest. $500 divided by what her total basis was, that was her rate of return, which is 4.4%. Ain't too shabby. And then we can go down here. She started the year with $18,203. She put $1,000 in, so $18,203. She put $1,000 in. All right, and her cash value increased by $2,229. Well, we know of that $2,229, 1,000 is $1,229 is her gain. She made $1,229 on 19,203. And the reason again I'm getting 19,203 is because that was what she started the year with cash, right? So that's what she started with, but then she added $995 in premium. So we got $18,203 plus the amount she put in, which is $19,203. But she made $1,229 in total interest on $19,203, and so she made 6.4% rate of return on that, tax free, by the way, 6.4%. Again, that's stellar. Guaranteed, by the way. Whole life insurance is guaranteed. It's literally guaranteed for your whole life. As long as you do what you're supposed to do, which is make the premiums and don't take a loan or anything and don't die, you're guaranteed to get a certain rate of return on your money. There's just no two ways around that. In this case, she made 6.4% tax-free interest. Again, let me just show you again. She started the year with $18,203. She ended the year with $20,432 in cash value, which means her cash value increased by $2,229. Of that $2,229, $995 was her premium. So you subtract $995 plus minus the $2,229, and that's what her true gains were. Her true gains were $1,229 on $18,203 plus the premium she put in, if that makes sense. All right, so that's pretty significant. And on top of that, her death benefit grew from $78,812 to $81,000. So that's a $2,500 increase in death benefit over the course of that year as well. We started with basically $60,000 of death benefit. Now we're up 33%. Because we're up to $80,000 of death benefit. I mean, so the death benefit is increasing, the cash value is increasing, and you can see when all is said and done in 2019, she started the year with $47,000. She put $995 in there. The cash value increased by $32.94, but because $32.94 includes her premium, it's actually increased by $22.94 divided by the amount that she had in there plus this amount right here, divided by 48,204. So in this case, she's a 4.7% rate of return. So what's happening here is, as she gets older, there's less cash value accumulated as an interest. And the reason for that is because the cost of insurance is actually higher, even though it's a flat cost of insurance, but the interest rates are lower as well as the insurance company's getting. So whereas the insurance company is essentially saying, look, before we were potentially paying you more than 4.5 because we had all these long-term bonds, they're not going to pay you more than 4.5 now. Right now it's 4.7. I can almost assure you it'll be stuck at 4.5 if that's what a guaranteed minimum interest rate is, because they're on the hook for that. Whereas before here, they were paying, she had a whole lot better because they still had a lot of bonds that had yet to mature. But when those bonds mature, they got to reinvest in whatever the bonds are at that day. And that's where these insurance companies are getting, and banks too, the net interest income is getting squeezed and it's hurting their profitability. Anyway, don't anyone tell you that that whole life is a scam. It's a scam to say that. It's just not. The problem is, as I said in my live stream yesterday to a lady, Ellie asked me, if you can take it out when you're young and fund that puppy significantly, it could be a great policy, because when you're young, the cost of insurance is cheap. Your underwriting is cheap because you're not likely to die from a heart attack anytime soon. And if you can fund that when the cost of insurance is cheap, you can really make headway on a life insurance. The problem is most young people can't afford it. They just can't. But in this case, a small policy can really pay off. I mean, she got $50,000 cash value in there. It cost her $26,000 over the course of 25 years or so. She doubled her money. She doubled her life insurance, and it's guaranteed. tax-free is growing too. So that's where the benefit can be. You just got to watch it. Again, these policies aren't going to pay what they are now. They're not paying now what they were because the interest rates are so low, unfortunately. Anyway, I'd love to hear your thoughts. All right, we'll see you.